When the stock market's at all-time highs, it can be a problem finding good companies at good value. So one thing you can do at any point in time, whether or not the stock market's at all-time highs, is find some companies near 52-week lows, which could potentially give a good buying opportunity for us investors at a good value. So today in this video, I'm going to be analyzing 3 stocks that are near 52-week lows and deciding whether or not we should be buying these companies today. The first company we're going to be looking at is Kraft Heinz, and as we can see in the stock chart, over the past year it's down over 16%, and the 52-week low is $25.44, which we are right near that 52-week low. If we take a look at the products that Kraft Heinz sells, we can see that they sell obviously Heinz ketchup and mustard. They also have Kraft, which they sell Lunchables, Miracle Whip, Oscar Mayer, Philadelphia cream cheese. They also have Jello, Kool-Aid, Cool Whip, a bunch of these products and condiments that they sell. So with that being said, I'm going to be taking a look at the financials of Kraft Heinz and seeing whether or not the business is financially healthy. And if we go ahead and take a look at the revenue growth rate for Kraft Heinz, we want this to be increasing over time. And although it increased in 2013 and 2016 and this time, since 2016, it's been slowly decreasing over time. So with that being said, Kraft Heinz sales looks very bad. I do not like to invest in any company that is not increasing their revenue. So with this being said, in the past 10 years, they've basically haven't grown the business at all. And if anything, they've declined. So this does not look good for the sales of Kraft Heinz. Now taking a look at the PE ratio and earnings of Kraft Heinz, which can show us the valuation that Kraft Heinz is trading at. If we look down here at the bottom of the screen here, the PE ratio is at a pretty low PE ratio. It's at a 12 PE ratio, which the stock market normally trades at about a 20 to 25 PE ratio. So with this being said, it looks like it is undervalued compared to the stock market. However, if we take a look at the earnings per share, it's been all over the place. And if anything, it's not really doing much. So this doesn't look good in terms of growth for Kraft Heinz. Even though it's trading at a low valuation, I wouldn't even be willing to pay this for Kraft Heinz just because of how slow this company is growing and actually declining. So this doesn't look good for Kraft Heinz. Even though it's trading at a very attractive price, I think that this could be a trap for value investors. Now taking a look at the balance sheet of Kraft Heinz, we can look at the total debt to equity ratio, which we want less than 50%. If the total debt to equity ratio of Kraft Heinz is less than 50%, that means that they have more than double the amount of equity compared to their debt. And as we can see right here, they have a 43.55% total debt to equity ratio, which looks good in that term. However, if we take a look at the total cash, they only have $2.8 billion in cash, while they have almost $22 billion in total debt. So they have a lot of total debt, especially when compared to their earnings, and their earnings is pretty low if we compare to that. And their free cash flow right now is at about $2.3 billion. So if they try to pay off this debt, it would take almost 10 years to pay it off. And normally, if we're looking at a company, we want to see that they could pay off debt at least 3 to 5 years. So right now, the total debt looks also very worrying for me, and with the earnings per share decreasing over time, Kraft Heinz look like they're really struggling. Taking a look at the analyst expectations for Kraft Heinz earnings per share in the future, we can see that analysts expect them to grow at only 3% in the next 5 years. So this is very slow growth, which I'm even surprised that they're expected to grow this much. But nonetheless, analysts do expect them to grow slightly, probably just because of inflation over time. So now for the most important part, I'm going to take a look at the intrinsic value for Kraft Heinz. Using an intrinsic value calculator with assumptions of the future, we can get a rough estimate where I believe we should buy Kraft Heinz at. So the first thing that I'm going to look at is the revenue growth rate. And analysts expected them to grow at about 3% each year. I think 2% is pretty reasonable. Just because of inflation is going to be about 2%, I think that they can keep up with inflation. I believe they do have some pressures in the future from companies such as Walmart and Costco making their own condiments and brands, where they could probably struggle in the future by not selling as much. So I think 2% is pretty reasonable just because of inflation growing at about that rate. Now for the net profit margin, we can see it's been about 7 to 10%. So I think a fair net profit margin for Kraft Heinz is 8%. Now for the cash conversion rate, we can leave at 100%. The terminal PE ratio. Since the stock market trades at anywhere from 20 to 25, which means for the total stock market, you're paying $25 for $1 of earnings from all the businesses in the stock market. Because Kraft Heinz is a lower quality business, I don't think that they deserve to be at that type of value. I think that a fair valuation for Kraft Heinz could be 15. I think a terminal P ratio of 15 is pretty fair. Now for the discount rate of 15%. If we have a discount rate of 15%, that's where I think I would want to buy this company, where we can make about 15% return with these assumptions. And as we can see here, we get a fair value price for Kraft Heinz at $17 per share. If you bought this today, I think you can make about 8% return. So with this being said, I think Kraft Heinz is a value trap, and I think it makes sense why it's at a 52-week low. It is a very low quality company, and I just don't see the attractiveness in this company. Look at the next company that's near 52-week low. We have Procter Gamble, which is the biggest company that's near a 52-week low. With a market cap of almost $400 billion, we can see Procter Gamble in the past year is down about 2%, so the stock hasn't moved very much. But if we can take a look at the 52-week low at $156, right now it's trading at $160, so it's right near the 52-week low. And most people probably have heard of Procter Gamble, but they don't realize the amount of products that they actually sell. If we take a look at the companies that Procter Gamble owns, we can see that they own Love's, Charmin, Pampers, Bounty, Dawn, Tide, Swiffer, Mr. Clean, Olay, Crest, Gillette, Vicks, Oral-B, Head & Shoulders, all these companies that they own, which is basically that everybody needs in their day-to-day life. So a lot of people like to buy this company for the safety during recessions, and this is a very big consumer defensive stock. Also with a good dividend, they've increased their dividend for over 50 years at least, so that's why a lot of people buy this company. However, with it trading at 52-week lows, let's see if we should be buying this today and get an actually good dividend yield, which the dividend yield of Procter & Gamble is at 2.6% right now. So let's go ahead and take a look at the financials of Procter & Gamble. Taking a look at the revenue growth rate of Procter & Gamble, we can see that in the 2010s, they had a huge revenue number right here. But in 2014, they had a huge revenue decrease. I do not know the exact reason for this. I don't really know why this happened, so you'd have to research why. But since that, we've seen very good growth out of Procter & Gamble, going from $65 billion all the way to $83 billion. So they've been actually increasing at a decent rate, which looks much better than Kraft Heinz, which was basically stagnant for the whole 10 years. So this looks much better than Kraft Heinz. Now taking a look at the earnings per share and PE ratio, we can see the PE ratio has been increasing steadily basically every year, which isn't necessarily bad or good. However, I would like to say, look at the earnings per share growth. It is not growing very fast. However, the PE ratio has increased by a huge margin. So this shows us that over time, the valuation has been going up, and we've seen multiple expansion from Procter & Gamble, which is probably not a good thing for us investors if we're trying to buy today. Obviously, it's good if you bought this company over 10 years ago because your stock price has gone up more than the amount of earnings that they have made. So this is not good for us investors today looking to buy. And they're trading at about a 25 PE ratio, which is almost over the market average. So they're trading at a pretty hefty valuation, even though their earnings per share isn't growing very fast. So this I would be very careful of, just because they're trading at its highest valuation in the past 20 years basically, and with their earnings per share growing just as slow, I don't see the big reason why this valuation is so high. So I would be worried about that. If we take a look at Procter & Gamble's debt to equity ratio, we can see that it's at 65%. So it is higher than Kraft Heinz, but in terms of the total cash and total debt, we can see that they do look better than Kraft Heinz. Having a $9 billion in cash and $34 billion in debt, at least that they could pay off more than Kraft Heinz. And also taking a look at the free cash flow, they have about $12 billion in free cash flow, so they can pay off this debt in less than 3 years. While Kraft Heinz, it would take about 10 years to pay off their debt. This looks a lot better in terms of the balance sheet for Procter & Gamble. Although it's not amazing, it is still pretty decent. And taking a look at the analyst expectations for Procter & Gamble, they're expected to grow at about 5% over the next 5 years each year. So this is once again not very good. However, at least they are higher than Kraft Heinz and growing probably faster than inflation. So this looks okay, but not amazing. Now taking a look at our intrinsic value calculator for Procter & Gamble, I'm going to put a revenue growth rate, I would say of 4%. I think 4% is pretty reasonable for Procter & Gamble. I think that they're going to grow faster than inflation. However, I don't think that they're going to grow that much faster. And as we can see, over the past 5 years, they've averaged about a 4% revenue growth rate, so I think it's fair. Now for the net profit margin, I think that they can go at 20%. I think over time they might increase it very slightly to 20%. So I think that's fair for Procter & Gamble. Now for the terminal PE ratio, I think a terminal PE ratio of 20 is fair. I do think that they're slightly lower than the stock market average, I think, just because of their revenue growth rate. However, I do think that they have a pretty good moat and competitive advantage. So I do think that they deserve a decent terminal PE ratio, but not as good as the stock market, but definitely better than Kraft Heinz, because the financial health of Procter & Gamble looks much better. And now for the discount rate, we're leaving at 15%. I get a fair value price at $91 per share. I think if you bought Procter & Gamble today at $161, you can make about 7% year over year return. So it is underperforming the stock market very slowly. However, with Procter & Gamble, they'll probably do better in recessionary times. So I do think that if there is a recession happening, I do think that this company will definitely withstand it and look better than, especially than Kraft Heinz. So right now, I don't think that Procter & Gamble is a buy as of today, unless you want a company that's very good dividend company and just going to give you subpar returns. But I'm not looking for subpar returns. But once again, I think if you are a dividend investor, I don't see you going wrong with this company. I just don't see you making a huge return. Now for the final company that's near a 52-week low, we're going to be looking at Copart. Copart right now is at $49, and at 52-week low of $47, Copart's a pretty interesting company, and I've been interested in looking at this company because Copart is actually an online vehicle auction company that specializes in the sale of used, wholesale, and salvage title vehicles. And I think this is a pretty interesting company because they auction off cars that have been in wrecks and that are in junkyards, and I think that this could be a pretty cool company to invest in. And I think that they can make some good money, especially if people start to want to buy cars at cheaper prices and rebuild their own cars. I just think that since car prices at such highs, I do think that Copart could be a pretty decent company to look into. And if I take a look at the Copart revenue, we can see why I really like this company. Look at this revenue increasing at a very good rate at about 5 to 15% each year. So this is why I really like Copart's revenue. Their sales have been increasing at a very good rate, so that's why I like the company. If we take a look at the PE ratio and earnings per share, we can see that their PE ratio has been increasing over time, but as of today, they're trading at about a 32 PE ratio, which makes sense because of their earnings per share growth rate. So at least they're growing pretty fast, and their PE ratio isn't totally out of control. So this doesn't look too bad for Copart. If we take a look at Copart's balance sheet, we can see another reason for why I like this company. With a total cash of $4.4 billion and total debt of only $100 million, they can pay this off with one basic check. This is a very good balance sheet, especially with the total debt to equity ratio at 1%. This just looks insanely good for Copart on the balance sheet end. And looking at analyst expectations, they're expected to grow at about 10%. So this looks pretty good for Copart. Now going to the intrinsic value calculator, I think that they're going to grow their revenue at 10%. Now for the net profit margin, I think a 32% net profit margin is fair for Copart. Now for the final thing, I'm going to put a terminal P ratio of 25. Since they're growing at a pretty good rate, I think that they deserve to trade at about this price. So with this being said, I get a fair value price of $36 for Copart with a forecasted return of almost 11%. So I think if this company does go down a little bit more, I might be very intrigued in buying this company. So thank you guys for watching this video on these stocks that are near 52-week lows. While there wasn't any stock that I would say to buy right now, I do think Copart is the one that I would be more inclined to buying in the future if it does go down a little bit more. So thank you guys for watching. Please subscribe, hit the like button, and see ya.